The global dovish wave has only strengthened since we introduced this theme in our April Global Focus. Slowing growth, lower than expected inflation, and rising downside risks have caused central banks around the world to turn increasingly accommodative. While we see downside risks to growth from weakening sentiment, a series of policy responses should be implemented to avoid a major slowdown. In particular, the low inflation environment allows monetary easing to be credibly implemented. We see three broad factors determining headwinds or tailwinds for global growth: US trade tensions with the major partners, the policy outlook for major central banks, and oil prices. All three factors affect sentiment and economic activity, both investment and consumption. Trade tensions are dominating market attention, and lower inflation outcomes are enabling major central banks to respond. Crude oil remains in the Goldilocks range of $55 to $80 per barrel, and both current and expected inflation is generally low. China's economy faces significant headwinds, including slowing industrial profit growth, the ongoing US-China trade dispute, and moderating external demand. Despite these challenges, we expect growth to remain steady in the second half, propelled by pro-growth policies and a resilient consumer market. On the trade front, talks with the US have restarted, but even if a deal is reached, the pattern of unpredictable developments is likely to persist as the US 2020 presidential election approaches. The US economy is on a solid footing, but faces mounting risks from trade tensions. We expect a 25 basis point cut in the Fed funds rate in July and a second 25 basis point cut in December. The expected easing is largely preemptive. Politics and foreign policy remain uncertain. More clarity on the potential 2020 presidential election outcome should emerge when the field of Democratic candidates narrows from the current record number, likely by spring of 2020.